Rothschild, nothing I say is an investment advice. I have no intention to replace any content of security analysis, but to open it up for discussion. Today we're doing Chapter 39, Price Earnings Ratios for Common Stocks and Adjustments for Changes in Capitalization. So prior to 1927 to 1929, apparently the PE ratio being 10 was considered to be a standard point of departure, so higher than that, higher quality. Lower than that, slightly lower quality. Fairly self-explanatory. And then in 1927, he says that, the PE of 15 would be considered to be like good stocks. And these were more like industrial type affected PE expectations. So maybe the Dow today would have a PE of 15, and that was like expected because that was like slightly higher quality than the normal. And then you have even higher expectations of PE quality being utilities and chain stores, which could range between 25 and 40. My understanding through my own research is that obviously today there's a heck of a lot of companies that have PE ratios that are a heck of a lot higher. And part of that is the expectation of the length of how long a corporation is able to last. And that has been growing since the 1940s, probably before then. And so it has to do with, earnings per year, dividends per year, the series of payments that are available for how long, and that affects the entire price of any security, really. But I digress. We're going to move on and get through this chapter. So after 1932, he mentions how PEs were higher because long rates were lower. So we're talking about treasury rates, and so when it's easier to borrow money, that's an additional type of stimulus for companies for their PE ratios to be allowed to be even higher because of the relationship between guaranteed return and the kind of return you can expect with a little bit of risk. So then we move on to note that the exact appraisal is impossible for stocks. And then we have a quote on 531, page 531. And this kind of restates how he said many times in this book from the very beginning. I remember this from the introduction. Anyway, I quote, "Hence the prices of common stocks are not carefully thought out computations, but the resultants of a welter of human reactions. The stock market is a voting machine rather than a weighing machine." Like I said, he said that exact same thing at the very beginning of the book, even the first few sentences or something like that. And so this gives sort of a sense of the idea that he's kind of saying, give up, pricing stocks as futile. However, there's always a but. With everything that Graham says, there's always a but. And he has three main points to this. He says, the analyst can set up a conservative basis for valuation, like before 27, where the PE was expected to be 10. And earlier, like in earlier chapters, we've talked about how book ratio kind of meant everything, but that's another subject throughout the book. But number two is for the analyst to see significance of capitalization, structure, and source of income, giving an idea of how to do this. And then number three, the ability to find unusual elements in the balance sheet. And so these are the three elements to be able to find good value in stocks. And we have a subtitle, I quote, "Suggested Basics of Maximum Appraisal for Investment." So the expectations for expecting higher future earnings from specific special occurrence, otherwise average earnings of a period of 5 to 10 years. So say suddenly everyone comes down with a disease and the only remedy are swamp cards from Magic the Gathering. Well, suddenly, that meets the first expectation, of a specific special occurrence. And otherwise, outside of special occurrences, we're talking about using the average of earnings between 5 and 10 years. And I'm glad that I read this book because I've come across online calculators that have used supposedly the Graham valuation for stocks using a 5-year calculator, and then other areas where it says 10 years. And so, but he says right here in this book that it's a range between 5 and 10 years. And so to me, that means maybe, a company that's only been around for 8 or 9 years or has, valid earnings, as soon as a company maybe becomes profitable, like let's say it's been unprofitable for 4 years, but then on the 5th year it's profitable. Maybe we start with that year, and then as long as there's 5+ years after that, we can count those years as far as figuring out an average earnings in order to help evaluate the stock. Anyway, moving on, we're gonna the next point I think is important to note and remember is that he says that a more liberal valuation is acceptable for companies with better earnings than normal. So within its, say you have a company that makes computer chips, and you have 10 companies that make the same computer chips, but for some reason this company is making much better earnings than normal. That can make you be able to allow for a more liberal valuation for the company, and then companies with better prospects or better stability of earning power. That's a powerful statement there. So that it's a 3-pronged statement, and you can use any one of those 3 to kind of give you confidence in a certain company and investing in their stock. So then we move on. He mentions that a PE of 20 should be the absolute maximum for investment in a stock. And this is different probably from today. Like I said earlier in this video, the expectation of how long a corporation can last is longer today. Companies have proven to be able to survive longer. And so if you can count on an increase of earnings for a longer period of time, the PE ratio suddenly, you can allow for even a higher PE ratio. However, with that said, it's funny to me to see companies today selling at PE ratios of over 200. It's like, is this company going to be, expanding their earnings like progressively for the next 600 years? I mean, that it almost anyway, I digress. I do think it's I mean, maybe this is one of those curves that is exponential in nature, where the average length of the existence of a company will actually just keep growing. I mean, I don't know. I don't know how this works. With technology increasing so greatly and making it so much easier for humans to be more successful. I mean, maybe PE ratios of 200 are perfectly fine today. Who am I to judge? Or maybe we're in the greatest financial bubble of the history of the entire world as of November 2023. I don't know. We'll see. Again, I digress. He admits in the book that having a 20 PE ratio as max for the being investment quality is somewhat arbitrary, however not fully. He says that a higher PE ratio of that for him in this period equates having no margin of safety. And it's somewhat reasonable if you put yourself in 1940 and just look at the history of the world. It's a reasonable place to be. However, today, with companies, again, lasting longer, who knows how long Coca-Cola, Apple, and NVIDIA and Google will be around. I don't know. Maybe they'll be around for the next thousands of years. I don't know. However, from this perspective in 1940, he says that paying more than a PE ratio of 20 is speculative and not an investment. And, part of this is the fact that a PE ratio entails that the company is making a 5% return. A company making a 100% that has a PE ratio of 100% is making a 1% return. Now, as of today, U.S. Treasury securities and the U.S. dollar as of today is still the global reserve currency. When you can make a guaranteed basically 5% return on your dollar and you have a company that has a 1% PE, 1%, 1% PE ratio, you understand what I mean, where it's 100, and sometimes it's 200, it's higher than that in some of these companies. Yeah, that starts to look a heck of a lot more and more speculative. I'm going to be doing some videos soon about what I think is going on in the markets. I think we're in a much bigger bubble than most people believe we're in. But again, I digress. Moving on, he mentions very few speculate well. There are some people. I mean, part of this statement is that there are people that speculate well. I think Cathie Wood is probably one of them. She's one of these people that is digging deep into these new super techie companies that she describes as disruptive technology, which Graham would appreciate, the disruptive technology thing. He basically talks about that in this book many times. So, but he says, so his point being is that, if you habitually, he says, buy stocks with a PE ratio above 20, you will lose money in the long run. And, that's a testament to his experience. Again, that number has probably been raised since then. By how much? I don't know. But I suspect it's a little less than how current markets price stocks. But that's a whole nother subject. Again, I digress. And then, so moving on for these numbers, he says a PE ratio between 12 and 12.5 is suitable for normal prospects. And so, 20 is like you're expecting unbelievable, security and growth and stability of earnings. But normally 12 to 12 and a half is okay. And then I like how he says a point here that besides the PE ratio, the company must have satisfactory financial setup and management and not unsatisfactory prospects. And I find that to be very interesting and illuminating wording, not unsatisfactory prospects. So satisfactory prospects are okay, but not unsatisfactory prospects. And you don't even have to have like amazing prospects. So, again, this is why Graham is considered to be like the grandfather or godfather or whatever of value investing, right? And then from my notes, might be wrong, but even with all of that, it's still speculative to have a fair chance of appreciation of value. So, you're buying something at 12 to 12 and a half PE, and it's still speculative at that point that you're still going to be having an appreciation of value of your stock. And so he's looking for better deals than that. So lower than 12, I guess. Now, in this period, he says that Wall Street defines investment quality stocks as any PE over 20. So in other words, the market is pricing like a premium on the security and prospects of companies, and that is investment grade. And Graham says that that's simply giving you a higher than normal price, and if you're going to be doing that, then you're adding a speculative element to this. This is not considered to be investment quality. Now, again, from the beginning of the book, he largely tries to inform the reader of this book the difference between what he considers to be investment versus speculation, and that knowing what that line is so that you're not taking unnecessary risk. When it comes to speculation, even like very successful traders today, understand the difference between a speculative hope and following rules in order to give you a certain probability of success. And I think that's largely how he sort of thinks about all of this. Moving on, we have some charts. He mentions blue chips that are great, but they're too expensive. And when something's too expensive, it becomes speculative. Nvidia, you know what? I'm on par with him on this, in seeing Nvidia and seeing its price and its PE ratio, in saying in my head, yes, wonderful, good for all you guys. It's too expensive. I mean, I knew about Nvidia like 25 years ago, and I thought it was a great company then just because of the products they produce. It's too bad I didn't get in then, but right now the valuation is just, it's insane. Graham would today, I wouldn't be surprised if Graham bet his entire net worth on shorting the semiconductor industry, but I mentioned that in the last chapter too. But moving on, I found it very interesting in the charts in this section that there's 4 metrics that he mentions for the companies in these charts, and he uses both the average of the 5-year history of earnings, so the last 5 years, and the 10-year average earning, and then you can compare those two against each other. I love that. So you take like 5 years and then the next 5 years, and then you combine it. It's like, that's such a great way of figuring out what's going on with earnings, like longer term. And then also the third metric being the highest earnings it's ever had and the lowest earnings it's ever had. And he also mentions in the book, what's the latest earnings as well. But I don't think he cares as much with that, except for the fact that, like, if you have a company that, like every other company in the industry, has like super high earnings and your company has low earnings, that's like alarm bells should be going off. That that kind of thing. It's pretty self-explanatory. But regarding these companies, he has the type A, B, and C charts. He regards investment quality as the C type charts, and I noticed that the PE in what he considers to be investment grade is mostly averaging around 6 to 7 PE ratio, much lower than the 12. And so, with 6 to 7 and everything else, you have all your other ducks in a row, you can comfortably assume that you're safe and that you can eventually achieve some decent capital earnings if it ever normalizes to the 12 PE ratio or higher, But other aspects of type C is the earnings are fluctuating but stable enough. And then there's a good capital setup, and then the next chapter is all about capital structure, and there's a lot to dive into with that. Really good stuff. I got, as of the recording of this video, I'm already a little bit into that chapter. But moving on, two of the examples I wanted to note from Group C have no bonds, no preferred shares, nothing in the capital structure above the common stock. And so, it's funny, like, as I've learned in the next chapter, and I'll talk about it in the next chapter, when you have more debt as part of your capital structure, it actually gives the stock more leverage in respect to its earnings. If you have never thought about that before, it clarifies a heck of a lot of understanding of how companies work and how stocks work in general. And in general, we'll get into it in the next chapter. I'm very excited about the next chapter. But anyway, as far as this chapter goes, I noted that it is very interesting that two of the examples in Group C have no bonds and no preferred shares, only common stock. So the common gets everything. Again, companies like this are going to be companies that probably, if they exist at all, they probably have been around a very long time to pay off all of their debt, and to want to have paid off all of their debt. It probably means that their life is somewhat limited too. But he talks about this too, is like if you have declining earnings, figure out, well, what's the minimum potential value here, moving forward. What's the potential maximum profits this thing can make. But anyway, the last point being for Group C is that he says that the purchaser needs to also believe that the prospects of what the company believes that they can achieve are fine, safe, secure enough. Next point, again, he goes into more detail, I believe, in the next chapter, but he mentions, and I quote, it's elementary to adjust for capitalization changes. So for stock splits, this is something that charting software does automatically for you. You don't have to worry about that part. Dilution is still a modern day issue. I find that dilution usually for most companies is small enough that it doesn't make it that big of an issue. And then again, with dilution, convertibles exercise, we'll talk about it in the next chapter. Part of it has to do with, I think accounting methods have changed since then. Biggest takeaway is that for earnings per share, you want to look at diluted earnings per share rather than basic earnings per share, and that's an important point. But again, that's for the next chapter. And he also mentions here, it's only an issue if it's substantial, and you do have some of these penny caps or penny stocks, that I've been involved in that have been involved with seemingly infinite amounts of dilution, and those are not fun situations, and the adjusted potential, when the adjusted market cap when it first went public is like $60 trillion, and today it's worth, it's the entire company is worth only like, a small amount. It's some of this stuff is comical. So again, let's move on. So I mentioned here that from my understanding, as far as dilution in these regards go, is somewhat it's completely irrelevant because of how charting software works. And today, outside of secondary offerings, outstanding shares, I believe when you look on your Yahoo charts or whatever, they include the convertibles before conversion. And I said this was a part of the next chapter. It's not. It's part of this chapter. But I alluded to it enough, you probably understand what I'm talking about already. So again, there's a basic EPS and a diluted EPS. Again, you just compare the two side by side. If the diluted EPS is like way lower than the basic EPS, that's like, oh shoot, there are so many convertibles out there that the earnings are a lie, and so your PE ratio is a lie. If there's such a huge difference. And then one other point that I want to add to this personally is that, if you have a stock that where the price is low enough, there's always a potential that the convertibility would be a non-issue, simply because some convertibles you would never convert them unless the stock price got high enough. You would just keep whatever you have, and you'd be better off than converting it to the stock if the stock never gets high enough. And so that's something to consider into this as well. And then we have a section on participating interest, which he discusses basically like compensation for people that work in the company, like, for example, like a CEO that have restricted stock. And he has an example of Trico Products Corporation, where after the restricted stock, I don't think this exists exactly anymore according to the research I did, but this company apparently had a rule that the common stock is able to receive $2.50 per share, and then all the money after that is divided 50-50 between common stock and the restricted stock. And so you have the insiders that get half of all of the extra earnings on top of $2.50 shares. So, that basically, I mean, now that I'm looking at it now, that's basically, I mean, it's slowing down the potential profit of the common shares in that case. And again, I don't think shares like that exist anymore. I would think that kind of a thing might be illegal at this point, because it seems like it would be more intended to be extremely highly manipulative, if that were to exist today. And I don't think that it does. Please comment in the section below if you know anything about this subject. I'd appreciate it greatly. But in addition to that, it's in the part of this last part of this chapter, it's good to be aware of any kind of extra compensation that the CEO or the top people in the company will receive from extra profits, because normally that kind of extra profits are going to go to the shareholders, and it's good to know if you're not going to be getting those extra profits as a shareholder and they're going into the pockets of the people that are operating the company. So, and that's the last point of chapter 39. That's all I have to say about this chapter. Hope you enjoyed. Rothschild.